Hello, everybody. Thanks for joining us today. Excited to be back with you. No, it's been a few months. We have a very exciting topic to talk about today on our latest edition of the Established ESOP Forum. Um, Today, we're joined by Jeff Jamarino and soon to be joined by Brian DeMag, a valuation specialist at Vision ESOP. That being said, today's theme is really going to be focused around valuation hot topics. We're going to start with why do we care? Why do you as a board member, why do you as an executive, why do you care about the process? Obviously, we're all concerned with the stock price, but want to provide some color and fill in some gaps on how important the valuation process is, help you understand what types of things valuation advisors tend to go through, both from a macro perspective and a micro perspective, and kind of pierce the veil a little bit, so to speak, on what's happening with those valuation advisors and what they're doing behind the scenes. So very excited to have you here from the team today. We're going to cover some good ground. As always, please ask questions throughout the process. You're welcome to put them into the chat box, and Danny or myself will, or any of the other moderators or presenters will see them, and we'll be able to answer your question in a timely manner. So really excited to get started. And with that, thought I would turn it over to Jeff. Jeff's been around on previous of our other calls. He can kind of reiterate his position. But Jeff, remind us who you are, and then tell us, why do we as an ESOP-owned company need to care about the valuation process, and what are some things that a prudent board or executive would do heading into a valuation update season?
Yeah, thanks, Josh. So just as a reminder, I am Jeff Jamarino. I currently serve as a post-transaction consultant for Lazier Capital. I'm out there helping our clients figure out the do's and don'ts after they've closed the transaction and what do they do next. So that's kind of my day-to-day role of what I do. In a past life, I ran an ESOP company, a reasonably large one that went through a lot of the things that we talk about in all of these forum conversations. And so hopefully bringing a little bit of the wisdom of that to these conversations. As to the valuation itself, right, it's kind of, I always think of it, it's kind of once you've created an ESOP, it's the heart of everything you do. I mean, the participants are excited about it, right? They want to know what their share price is, but more than that, it's really the driver for everything. It's the driver for being able to create annual statements that you can give to participants. It's the driver for things like SARs and warrants and all of those sorts of things that are driven by share price. So that can be really important as well. And the key, the approach I always took was as both a board member and a member of the management team, is that this is one of the most important things we're going to do this year, is to meet with our valuation folks, talk about, what did we accomplish this year? What were our successes? What were our failures? What went well? What didn't go well? And then discuss, okay, what are our plans for the future? What do our projections look like? What are we going to want to talk about in terms of valuation going forward? And I always felt that it was important to have a face-to-face conversation with our valuation folks. I know that doesn't always work, but I felt that creating that relationship, that connection, and being able to explain things face to face was really important. As a contractor, we actually even made the effort to, have a meeting with the valuation folks and then take them out to a job site and let them see and understand what it is we do and how we do it, so that they had a better feel. The more they understood about our company, the better that they could create a valuation for us and a good valuation. So I always looked at this as an opportunity to be honest and straightforward. It was never an attempt to hide something or not disclose something. It was important to be straight with the valuation folks to make sure that we got a number that was accurate and fair for all our participants. And that's really how we approach things. And I think it's, as you look as a board member, especially, and your fiduciary responsibility to the participants, you want to make sure that they're getting a fair price for their shares of stock that they have inside their accounts. And if the valuation process isn't handled properly and done well, then you're potentially harming the participants. So you really got a more than just a responsibility. You've got a fiduciary duty there to make sure it's done and done well.
Well said, Jeff. Thank you. And I'll formally introduce you to Brian DeMag over here. Hi, Brian. I see you're
Hey,
loved
Jeff.
Josh Zeidman today, so that's awesome. Um, Jeff, great tee up, for why we should have that hat on, why it's concerning, for us as fiduciaries or even executives to be concerned, right? We all want a fair value, and the better the valuation advisor sort of understands what makes us tick, the better we have in that value proposition.
Exactly.
Brian, happy to kind of turn it over to you. Maybe a quick introduction for yourself, and we can sort of talk about what you see on the valuation front as you do hundreds of these a year.
Sure, absolutely. Yeah, thank you. Thanks for the opportunity. My name is Brian DeMag. I'm the founder of Vision ESOP Valuation. So our firm specializes in just that, ESOP valuation. So as Josh said, we work with many valuation ESOP companies for their annual valuations as well as initial transactions. So today, what I'll really focus on, there's really two drivers to valuation. Of course, a big portion of that is the company's individual performance, so the actual company's performance. So your earnings growth, your diversification, your relationships with clients, succession management planning, all of those things. Those are so specific to each company that we're not going to dive deep into that, of course. We'll hit on some of the highlights and the key drivers there. But today I'll focus more on what's happening in the market and how that could potentially impact the ESOP valuation. So ESOP valuations are a little tricky because most of our clients, we do the valuation once a year. 90% of those are December 31st year ends, so you'll hear me reference that a lot. So since it's one point in time, things that happen throughout the year in the markets may not impact the business as much as where things are as of December 31st. Of course, this year, political stuff, there's a lot of unknowns towards the end of the year. But what I'll do is I'll walk you through a little bit of the key market factors that impact ESOP valuations, what we're seeing year to date, and then kind of give some examples. And I have a slideshow I'll pull up in a minute, examples of how those market inputs directly factor into valuation and could impact the subject company's valuation. Now, that doesn't mean that if the public markets are strong, that it's going to, pull up the performance. If your subject company is struggling, that doesn't mean the market's going to save you. On the flip side, if the subject company is doing really well and the public markets are doing poorly, that doesn't mean that the public markets are going to destroy your value. So they tend to move in tandem, but there can be divergence from that depending on the specific performance of the companies. And so this year is unique because there's kind of started soft. Now there's some positive momentum, and I think hopefully that continues. And so if you're looking at year-end valuations, we're hoping there's some positive uptick. But of course, it's unknown there. If you're doing a valuation today versus the beginning of the year, there would be slight improvement. Nothing dramatic. Again, this is just based on market. If your company was flat, the market's a little bit stronger, that would have a positive influence. So what I'll do, Josh, if it's okay, I'll pull up my screen share here, and I'm just gonna, I think I just need the permission on that one, and then I can pull up this PowerPoint. I'll walk you through a little bit more on the market factors, and then we'll hit on some of the company-specific ones.
Awesome. Danny, are you able to enable?
Yeah, I'm just troubleshooting right now. It looks like you should be able to.
Yeah, it just popped up here, so we should be good. Perfect. So again, I won't go into detail on all of this. Some of it's just, economic update news, but I want to talk about how link that to ESOP valuation. And so, as I mentioned, there's two pieces to each valuation. It's the company's specific performance, so things like earnings growth, debt repayment, that impacts value, and also you have the market in general. So when we're talking market, we're talking about the public stock markets, the M&A markets, and all of the factors that go into pricing, public stocks, private stocks, ESOP, all the different asset classes and different investments here are driven by similar factors. And so that's what we'll walk through today, is a little bit more of what's going on in the market and how we think that will impact ESOP valuations in 2024. So we'll go through a little bit of an economic update. I'll talk about M&A trends, and then we'll show some examples of how specific changes in market rates would flow into your valuations. So as I said, there's kind of things have bounced around this year. Again, I'm not going to go to a ton of detail, but things recently have been pretty strong. So a slow start to the year. Second quarter GDP came out, and it was a pretty good number at this 2.8. Historically, GDP runs around 2.5% per year. 2022 was around 2%. 2023 was about 2.5%. So this 2.8 is a favorable number. It's a pretty strong number. You can see the projected numbers here are not as strong, but does seem to be some positive momentum, which does play into the public markets and potentially ESOP valuation. GDP, nominal GDP, is this GDP plus the inflationary CPI, and that increased at 5%. So this is this quarter over the prior period, in prior year period. And so that's a strong number as well. Quarterly growth of 5% for the market is a pretty good number, and so that is having some impact into the public markets, where we're seeing some performance improvement. Of course, the big story for the last couple of years in the economy has been inflation. So consumer price index here will track it. As you can see, coming out of COVID, 2021, middle of there, and really throughout 2022, had some major challenges with inflation. How this plays into valuation is when you have this level of inflation, it pushes interest rates higher. When interest rates go higher, you have kind of a twofold impact on valuations. You have the company specific impact, which is higher cost of borrowing if you are borrowing, higher cost if you're looking at acquisitions or buying equipment. So it could slow growth. And also from a customer standpoint, you've got some pressures. There might be some construction projects delayed, or just a general slowdown in spending when you see these high inflationary numbers. The other place it comes into play, which we'll play a little bit more directly, is when interest rates go up, every return on an asset, every expectation for return on asset goes up. So if you were comfortable getting a 8% return on your public stock investments, maybe now that's moved to 12 because there's more risk, there's more pressure. In order to kind of break even, you need to get a higher return on your investment just to fight off inflation. And so that's really what you saw in 2022 and in 2023 was some pressure in the public markets because of this inflationary pressure. Positive sign is that has been 2024 and really the last 12 months, they've gotten a little bit more in control. And you can see here then through the last monthly number that came out in July was 2.9% for CPI. The Fed's target there is 2%. They've just recently said that they're looking at some potential cuts. That's all favorable to the public markets and in general to ESOP valuation, because as these rates come down, you'll see typically lower interest rates in general, mortgage rates, as well as bond rates, treasury rates. And when those rates come down, that means that investors are willing to take a little bit lower return. They see less risk in the market, take a little bit lower return and therefore you can pay a little bit more for a company, which then of course flows into multiples and a little bit higher values. So that's directionally where things are going. Whether the year ends like that, whether that actually plays out in the ESOP valuations, to be determined. But if you had a valuation today and everything else stayed the same, except for the market factors, it's most likely that you would have a slight increase due to some of these favorable changes. And there's kind of early stages for seeing the positive impact here. The public markets, and we tell all of our clients this, the public markets, while they do tend to have an influence on ESOP valuations, we don't see them, we don't see a direct major impact on ESOP stocks, meaning there's more volatility in the public markets. If the public markets have a huge return year, we wouldn't expect our ESOP clients to maybe get the same level of uptick. On the flip side, if there's a major correction in the public markets, the ESOP industry as a whole might not see as much of a dip. Of course, the public companies are very volatile because they're chasing quarterly earnings reports and targets. ESOP companies much more long-term focused, and therefore we don't see as much volatility typically in those valuations. This chart here is just showing, over the last year where the S&P 500 went. So these are large publicly traded companies. Not always the best index, but it's the most widely kind of followed index. And you can see, year to date up about 18%, full year up 27%. So really kind of fighting against some of those inflationary pressures. And as those inflationary pressures have started to subside, you're seeing the market react in a very positive way. So really back near all-time highs for the S&P 500. You can see in July hit that all-time high. First week of August was a rough week, and then it's recovered all of that. And the reasons behind this are a lot of it's driven by those expectations of lower interest rates in the future, a little bit more control of the inflationary pressures, and the earnings growth in these companies. Earnings growth is partially due to lower rates in the future and a little bit more of a positive outlook for performance in general. This is a positive trend. Again, we wouldn't expect every ESOP company to be up 28% because the market is, but it's moving in the right direction. And it's moving in the right direction because of those positive economic drivers. The biggest drivers to any company, any valuation, are earnings growth and less perceived risk in their earnings or in the future. And that when you see less risk, you see lower required rates of return. And that's what we're seeing kind of twofold here. So again, for large publicly traded companies, 80% of them in the second quarter kind of outperformed expected. And then not every single company has in the S&P 500 has reported yet, but of the 95% that have, that growth rate's about 11%. So that's the highest quarterly growth rate that the markets have shown since the end of 2021, kind of in that COVID bounce back. So again, that's favorable, and that's what's helping to drive some of the public market performance, which we again think will flow a little bit into the private markets and ESOP companies. This is a big number here. Public analysts typically are a little bit more optimistic, and you'll see these numbers be pretty strong. But what's really pushing the market more this year than even the inflationary stuff is projected growth. And so 2025 projected earnings growth is 15%. And again, that's S&P 500, the large companies. But that's a very strong number. And so I think that's why you're seeing the market move. So what this chart here, simple chart here, but is just showing the price to earnings ratio in the public markets for S&P 500. These are huge companies. It's high. I wouldn't compare this to any of our ESOP clients, but what we're really showing here is not the raw number, but the increase. And so from the beginning of the year, when the S&P 500 had a multiple about 25, it's up to 29. That's up about 17%. So what that means is that people are willing to pay more for each dollar of earnings. current earnings. And really the typical reason for that is because they think future earnings are going to grow. And so you're paying a higher multiple than you did 6 months ago because you think the future earnings are going to be strong. And so that's what you're seeing. So your combination of actual growth, these companies are doing well, and people are willing to pay more for every dollar of earnings because the outlook is strong. And that's what's really been pushing the markets here. So I'll pause a little bit there. Again, this is, the public markets definitely, influence what we're going to talk about next, which is the M&A markets. And it all ties together because when you're looking at kind of from an investor standpoint, what are the opportunities for returns on investment? It's public companies, it's real estate, it's private companies. They all do have a relationship. If one asset class becomes much more risky, you shift your dollars into something else. And so when you see this movement here higher in the public markets, it does tend to signal some positive movement in other areas. Any thoughts or questions from this group before I move into a little bit more of a M&A update?
It's great to see some of the macro factors and some of the more recent movement and I think a lot of the folks on the line sort of can better appreciate the interplay between a company's projections and stock price versus what's happening in the overall market, right? And not getting too high, not getting too low, because the needs are different, the reaction time is different. So it's helpful to understand that, and not overreact or underreact to something out there on the macro side of the market.
Yeah, and Brian, honestly, I thought you brought up a good point, which is, what's happening in the broad stock market certainly kind of reflects what's going on in the overall economy and how valuations might be viewed. But there's not an exact or direct correlation there that we have to understand that ESOPs are valued differently than what's going on in the broad stock market. So great point. Thank you.
Absolutely. Yeah, and of course, every minute or second, public companies are valued because they're traded. And when it's once a year for the ESOP companies, it is kind of a unique scenario where, of course, everything that happens throughout the year will impact it. But when we're looking at just valuation once a year, it's really like where are the multiples at that point in time? Where are the markets at, the interest rates at that point in time? So you could totally have a year where the first 9 months of the year are very challenging and it finished strong. Now we would expect then the company to have similar performance if they tend to follow the markets where the company maybe didn't have great performance, finished strong. But from just a pure rate standpoint, it is important where the markets end on that December 31st point in time, just because of the way that we look at valuations. But yeah, the volatility in the public markets is not what you tend to see in the private valuations, again, because of it's once a year. But overall, if we did this in January, February, you'd probably have a little bit different tone where there's still so much uncertainty about inflationary pressures and economic growth that you weren't really seeing a strong outlook. Of course, there's a million different opinions on where the market goes from here, but the data is pointing, at least through July, August, to be more on the favorable side. The next thing we're going to talk about is trends in EBITDA multiple. So again, with valuations, you typically have what we call an income approach, which is looking at what would an investor pay for the future cash flows of the business, and that's based on what we think the business can generate in cash, and then what would an investor pay for that based on their return expectations. The simple math on that is like if you had a company generated $1 million and you had a 10% required rate of return, you could pay $10 million and get that. If your required rate of return was 20% because you saw more risk, then you would only be able to pay 5. And so that's how the interest rates and everything ties into a income approach. it's directly impacts tied to a market approach, but you just see it a little bit differently. You see it in a multiple. So instead of a required rate of return, you see in an income approach, you see the multiple in a market approach. And so we're going to focus on EBITDA multiples here. That's the most commonly used metric, earnings before interest, tax, depreciation, amortization. It puts a lot of companies kind of on an apples to apples basis, so it's easier to compare than revenue or profit, things like that. So what we're looking at here today, this is GF data. It's a source we use to track private transactions. So it could be public companies as well, but it's closed mergers and acquisition activity. And so these are deals, closed deals that are submitted by the sell-side advisors involved in those deals. So it could be like a Lazier. I know Lazier doesn't share their information, but some other firms would share their, not the names of the companies, but hey, here's the multiples that we saw in our deals. And they do that so they get free data back. But what this shows here is the volume of closed transactions, US-based transactions over the history, and then the average multiple on those transactions. And so 2023, of course, was a quieter year in the transaction world, mostly because the interest rate environment was challenging. It was 2022, you saw a big pop in inflation stuff, but you didn't see as much movement in the financing piece. There was a little bit of a lag. 2023 had a full year of very high interest rates, and therefore, deal volume did slow down. And you also saw a little bit of a dip from a pricing standpoint because there were just less deals happening, and companies were struggling a little bit because of the pressures there, or project delays and things like that due to the environment. 2024 year to date, this goes through June, is almost, the volume itself is almost in line with the full. Actually, this is the deals. They're above where you were at this time. Actually, yeah, right here is last year. These are labeled wrong. Sorry. So this is volume here, and they through half of the year almost eclipsed where they were the full year last year. So that's a sign that deal volume is definitely ticked up, and you also got multiples that have ticked up over that same period of time. And so again, similar to the public markets, you're seeing some positive movement in the M&A market. This is PricewaterhouseCoopers, just some data that they shared. We've been hearing this for years. A lot of capital on the sidelines, called dry powder for private equity companies. So a lot of cash that private equity companies are trying to get into their portfolio companies or find new companies to acquire. Again, that slowed a little bit, but there's and when it slowed, the deal activity, that you got a higher buildup in this capital on the sidelines, and therefore there are positive signs that there's still a lot of activity to come. This is worldwide. There were some very large transactions early in this year, so overall deal volumes are up. You can see there's a lot of interest by companies, and I'd say for our ESOP clients as well, we've seen more acquisition activity of our ESOP clients buying other businesses to stay competitive. And anytime you've got a kind of rapidly changing environment or competitive pressures, that tends to be an area of growth through acquisition, and we're seeing some of that. And then they also point out there's just a lot of activity on the political side of things as well that are influence the markets. This data shows this EV is total enterprise value. So it shows ranges of size of companies. Typically, larger companies carry higher multiples because they have more access to capital. They have a deeper management team, more diversified, those types of things. So we won't talk through that as much, but here we're just looking at overall. There are 90 transactions in this database in the second quarter, and 90 in the first. The multiple has moved up slightly, so about a half a turn, we would say about 0.5 in the multiples from first quarter of the year, which was a little bit softer, the second quarter of the year. Some interesting things that go on throughout here. typically, this drop from in these $100 million to $200 million companies is a little bit unique. And really what they're saying is that's because the highest quality companies in this set have been basically holding off. They're not going to market. They're anticipating higher multiples in the future with rates improving. And so the set of companies in this 100 to 250 million range, they believe are lower quality, and that's why you're seeing this little bit lower multiple here. High quality companies are still getting strong multiples, but overall we're seeing that there has been, again, a little bit of a positive uptick in multiples recently. Again, this data is all a little bit dated. Can't put out August numbers yet. But what we're seeing in the public markets here recently would indicate that if the M&A markets track that, there might be a little bit more upward room here towards the end of the year in multiples. But overall, it's still a very healthy market. I think the important thing is that deal volumes have come back this year. There's just been a little bit more of an opening there versus what was a pretty hard pause in 22 and 23. This is just showing, again, this is a little bit more history, 23, 24. So while the second quarter numbers have moved up a bit, the year to date is not dramatically different than 2023. That's just because of this, tracking the full year. But we have seen some uptick on a broad range of businesses. Specifically by industry, again, we won't get into a ton of detail, but see similar movement. Manufacturing companies have moved up a little bit. The one on here, which normally would be surprising, but I would think it's not for us, is the technology. You've had some staffing challenges. Some of our technology clients have struggled a little bit in 2024 just because the uncertainty by their clients on the interest rate environment, and they've paused some, I would say, discretionary spending. So maybe like a data analytics firm or someone that's doing some kind of forward-looking projects for their clients. They've seen some pauses there, say, hey, our client wants to do this, they will do it, but it's not an urgent project until they've delayed it. And so that number does make sense to us. We've seen a little bit of a pullback there. Of course, outlook is still strong with all the AI stuff that's going on in the industries, but there was a little bit of a lull here for a number of our clients in 23 and 24. So that just gives you a general feel, but overall theme again is that the market itself has improved. The public markets are showing that, and nothing big, no big movement in these multiples, but still a positive trend. And these multiples have been in a pretty healthy spot, really, for the last couple of years. Any thoughts there from the group on just the market multiples before I tie in a little bit more specific to ESOP companies?
Brian, you touched on something again. I'm just kind of got my ears tuned to things that really impact management and board members and that kind of thing. But you mentioned that larger companies are getting bigger multiples than, say, a company in a similar industry, but maybe a smaller company. And I think that's really important to point out to, especially board members, as you're thinking about your fiduciary responsibility and your obligation to make sure that participants are getting the best value on their shares that they can get. I know that philosophically sometimes some companies say, no, we don't want to grow. We just want to be this little company that we've always been. But the reality is that it's growth that really drives valuation and pushes prices up, whether it's through your multiples by having being a bigger company. You can have more professional management teams in place. You can have succession plans in place. You can do a lot of things that make you a stronger company. And by being a stronger company, you're pushing that valuation up. So I think that's a point that can be missed pretty easily, but I think it's really important for senior management and board members to understand that it's going to be growth that's going to help drive that valuation.
Absolutely. Yeah. And I think it's really easy for companies or people to hear what the public companies are trading for, or large transactions that get a lot of press, and you think that, 10 times, 12 times multiples are the norm. That is for large companies. Now, we always tell our clients, like, bigger doesn't necessarily mean better, but what comes with size typically leads to less risk. And all that comes down to a lot is diversification. Like you said, Jeff, you've got not maybe, a larger management team or diversified management team. Typically, if you're this size company, you can't be concentrated with just one or two clients. So small companies might have 80% of their work with one or two clients. Large companies, it's hard to get there. Geographic diversification. If you're a $300, $400 million type company, it's hard to do that in one state, one location, one region. And so it's those risk factors that actually get a little bit reduced when you're more diversified and larger. Now, we have some very small companies that are very diverse, and that's a big positive. And but typically it does come with size, where geographically, management team wise, customer vendor diversification, even international type diversification can help. But the smaller companies have the advantage of nimble, quick decision making. So there's pluses and minuses, but I wouldn't say chase. It's not chasing revenue and chasing sales dollars, but chasing diversification would be the biggest differentiator, I guess, or the biggest reason that these companies get higher multiples. And you can borrow more, and there's a lot of benefits to that as well. So to tie some of these numbers into valuation, so this focuses more on what we call an income approach, which is looking at what we think the company can generate from a cash flow standpoint, and then what would an investor pay for that cash flow stream based on the risks and really the required rate of return for that. This goes a little bit against what I'm showing in the market because it's dated. It doesn't catch up as quickly, and so. And I'll explain what that means. But when we're again, we won't get in a ton of technical detail, but when you're looking at the required rate of return for an ESOP company or any valuation, there's ways that we get to that required rate of return. So if you're thinking like from a real estate standpoint, an investor might want a 6-7% cap rate or return like that. We do the same thing with ESOP companies, or really any asset. Is the lower the risk, the lower the return. Higher the risk, higher the expected return. And so we get there for ESOP companies by adding on additional risk factors. So you really start with what we call like the 20-year treasury rate. So this is a government-backed 20-year treasury bond. You can see in 2021, very low rates. Not risk-free, they call it risk-free. I mean, there's always some risk, but very little. So you could get a very low return and basically very little risk back then. As this number has moved higher, it's more than doubled. It's right around 4.2, I think, today. As that moves higher, every other investment class, you would expect a higher rate of return. So if I can get an extra 2% on my treasury rate return, I would expect an extra 2% on my public company stock and my ESOP stock, really. And so if the companies don't grow fast enough to offset those higher required rate of return expectations, that's when you see downward pressure on stocks. And that's what you did see during this period, really 2021, 2022, when the rates were moving quickly, is you were seeing some pretty big downward pressure on stocks. Luckily here, again, this has come down. This is for 1 year, or this is year to date. You had a pretty significant peak here on 5%, and that's come back down to in the 4s. This number directly ties into every valuation, and so I'll just kind of functionally show you how that works. So when 2022 was a tough year for most companies from a valuation standpoint, and it was mostly market driven. I mean, performance for individual companies varies, of course, but the market, there are some major pressures that pushed values down. all else being equal, if our clients, if they performed similar from an earnings standpoint, the market alone pushed those stocks down 15-20%. And the reasoning was you had a higher risk-free rate of return and higher other kind of market rate of return. As that moved higher, again, there's less dollars available to pay for the same cash flow stream in order to get that return. 2022 it peaked. Things have come down a little bit in 23 and just a slight bit more here year to date. So this is where the actual rates that you see in the evaluation report haven't moved as dramatically as what you see in the public markets. And mostly because that the public markets are more forward looking and they're pricing in growth in the earnings. These data points don't capture that as much. Now, if the subject company is growing like the public markets are expecting, then you would see that have the positive impact. So maybe it doesn't come directly from the changes in the rates this year, but it come from performance. But overall, yeah, you're not seeing a big change in this cost of equity here, which would be the required rate of return for most of our ESOP clients are going to kind of fall in this range. So it's the risk-free rate of return. There's an additional required return for investing in large public companies that gets you around 9% return. And then you've got what we call typically a size premium, additional return for smaller companies. This might still be, $200 million in equity value, so still very large. But a lot of our ESOP clients are going to fall under that. And then you have the company-specific factors. Again, we kept that flat here just to show the example. But those are things like diversification. The biggest factors that play into that are customer concentration and really projection risk. If we have a client that never hits the projections but gives us a big number for the future growth, this company-specific is probably going to be pretty high. On the flip side, if we see relatively conservative projections and consistency there, this number tends to come down. So that's one piece of the puzzle. The other thing, what's moved more, kind of the opposite direction this year was senior financing rates. And we are starting to see that come down. But this is where I mentioned earlier, there's a little bit of a lag here with what's happening with inflationary stuff and the rates and what banks are charging. I never saw 10, 11%. Josh and Jeff, I don't think you guys that high probably either on some of our projects, but we did see movement. This would be senior bank financing, so kind of like your 5-year term loan type stuff. That again has started to trickle down. Last year at the end of the year was big movement, and this is why 23 you can see first quarter, second quarter, all through the year those were high rates. That's why deal volumes were down for part of it. And why some companies struggled a little bit from a cash flow standpoint. Luckily, again, that's starting to come down as the inflationary pressures and interest rates as a whole have softened and come down a little bit, and that is favorable. So, directly in the valuation, you'll see the cost of debt here. This is just showing an example again of where that hits. This is when you look at anyone has a weighted average cost of capital shown in their valuation. There's a portion of the required rate of return is assumed that you can borrow debt and kind of lower your overall cost. But these rates have moved, and so higher debt does have a downward impact on the valuations with everything else being equal. So this example here was showing if we had the same exact company performance at the end of the year, we saw a little bit of improvement in the risk-free rate, but we saw a bump in the senior financing rates. That here you would actually see a little bit of downward pressure in the valuation. Now, where I think that would be offset in reality is that the risk, these rates here, equity risk premium, probably comes down towards the end of the year if the market continues to see favorable performance, or the actual company risk. If the company is doing well, which we're seeing in the public markets with the earnings growth, then those numbers could move. So There is a little bit downward pressure due to, again, still the higher debt rates, but that does seem to be coming down pretty quickly. And so, yeah, there might be, it's not like a double positive like we saw a couple of years ago with the rate improvements, or on the flip side, a double negative when you saw the rates going up. There's still a little bit of headwinds from a cost, interest rate standpoint. But again, since the reality is they're still high, but the public markets and what we do in valuation is all forward looking. And so we're more looking towards 2025 in the future. And so I think most likely if the companies are performing well, this number gets, offset. You won't see a drop if you get companies doing well. Well, those are some functionally kind of how things are lining up. Again, so outside market is really is pretty favorable through August. No dramatic movement that we're seeing, but I think the signs are for a little bit stronger valuations as a whole, based on market factors. Again, we can't, we're not going to go into all of the specifics for companies. We have a lot of companies who are doing very well. We have other companies that have been struggling. It's a mixed bag, but these are still continue to be the biggest drivers to valuation from a company specific standpoint is growth in earnings and minimizing risks. And so again, just different factors that we look at each year in our valuations. Again, part of it's industry, economic, market driven. The other stuff is more company specific, which is labor related. We are seeing a little bit of improvement there. It sounds like from a lot of our clients we've talked to, is there's a little bit more access to labor. Maybe not highest level talent, but a little bit more opportunity there. And then, the other things we continue to focus on with clients each year is if you're giving them value drivers and ideas, there is all surrounding diversification, is succession management planning. It's to kind of have plan B, and if someone got sick or retired, and then same thing from a client vendor standpoint, is not get too tied into one or two relationships because of some of the volatility in the markets. So those are really the, and we can answer any questions about specific stuff, but again, wanted to focus a little bit more on the general markets and how that plays into valuations year to date. And again, not to give opinions of where I think the year is going to end up, but there does seem to be a positive trend in the multiples and the interest rates, which do move together typically and are showing a slightly stronger environment for valuations and ESOP valuations.
Brian, thank you very much.
Absolutely.
So it sounds like we all should go back and at the end of the year work with our valuation specialists, ask to see the weighted average cost of capital calculation, and push some buttons a little bit. And I'm being half serious, but I do think it's very worthwhile of an exercise to understand what that buildup is and some of those numbers that Brian goes through. I mean, that cost of debt and cost of equity, they're big components to how much we discount a company's projections that feeds into value. So great commentary. Good to see maybe some positive tailwinds, maybe a little bit. I know 2022 was very challenging, and I saw a lot of my clients have great years, but not see the stock price increase that they thought. And it's good to be through the cloud a little bit and get to see that was not, a little bit more atypical than a normal year, quote unquote.
Yeah, I can only think of, in my history, you had only really two periods where the market directly impacted all businesses, and pretty specifically is corporate tax rate changes that had a big impact, of course, and then this swing from 2021 to 2022, from an interest rate standpoint, is when you have a risk-free rate that doubles. That alone has a 10% or so impact on valuations. And so yeah, similar story where we had we had companies that had really strong years, and maybe they weren't down, but they were flat, and it didn't make a whole lot of sense. And that was the year where we really did go through some of this more specifically. Is like the market does impact your business, maybe not, you know, at a super high level, but it does impact your business, because people are looking at private valuations and investments, or where we're looking at it saying, hey, trustees and investor, or people are investors, like if the required rate of return for public companies or other assets went up, well, it absolutely goes up for ESOP companies as well. And so, yeah, and if we saw this risk-free rate drop down to 2, that would put a lot of upward impact on valuations across the board. The difference is that the public markets do tend to get a little bit of jump on it because they're more forward looking, and since they are more forward looking, there's more volatility because it's speculative. And so the growth you're seeing in the public markets, we all hope sticks and is real, but there's also they're basing that on 15% earnings growth next year. There's a lot of risk in that number.
Well said. And I'm just checking. You did such a fantastic job, Brian and Jeff. I don't see any initial questions in the chat box. If you have any, feel free to let us know. You're welcome to email afterwards. But this is great. You know, the valuation process, you're doing this every year as an ESOP company, as a board, as executives. The better you can understand what Brian and those folks have to go through, the better advocates we can be for our ESOP, for our company, for our stock price, and really understand how to move the needle. So I think that's what Jeff and I were hoping folks would take away from the presentation. And Brian, super appreciative of seeing where the trends are. I learned a ton and have some optimism heading into Q3, Q4 a little bit now.
I hope so.
Didn't know there were 60 elections up for
I didn't either.
up for grabs in 2024. That's a little bit concerning, but I'm sure we'll make through it as a world. Okay.
Great. Thank you, Brian. Really well done. And as Josh said, it really hit the high points from a management and board standpoint of making sure you understand how these things work so that you can better manage and control where the growth and share price of your company is going.
Well said. With that, happy to end this session. I hope folks had a great time and learned a little bit as well. And we look forward to picking this back up in a few months for our next established ESOP forum. So thank you all very much. Have a great day.
Thank you.